Warriors of price action and guardians of fundamentals. Welcome back to Retail Recon. Today's mission, option Greeks Vega and Gamma. After delta and theta, this is the layer of intelligence you need if you want to understand how volatility and acceleration shape your trades. This is the hidden layer under every earnings trade, every big move setup, and every volatility-driven strategy. Let's start with Vega. Think of Vega as your volatility sensor. This metric tells you how much your options price is expected to change for a 1% move in implied volatility. If your option has a Vega of 0.10, a 1% increase in implied volatility will add roughly 10 cents to the option price, all else equal. And vice versa, a 1% decrease will subtract roughly the same amount. The key idea behind it, high Vega means your option is highly sensitive to volatility changes, and low Vega means your option is less responsive to them. Who benefits from Vega? Buyers love positive Vega. When volatility spikes, their options inflate in value even if the stock hasn't moved much yet. And of course, the opposite is also true. Sellers hate it because the options they sold gain value quickly, increasing their risk. Vega is especially powerful around earnings announcement, big news events, and market shocks. That's why options are often expensive before earnings, as you are paying for high Vega, not just directional exposure. Gamma is the rate of change of delta. Think of it as your acceleration switch. It answers the question, how fast will my delta change when the stock moves? High Gamma makes your delta change rapidly, and the opposite is also true. Low Gamma means slow influence on delta. Gamma is particularly important when you are basing your trade on delta values. For example, when selling a short call in covered call setup. Let's assume you are looking for a delta anywhere between 10 and 20, but you ignore the Gamma value of 25. Next thing you know, the stock moves up by $1 and delta on your short call just went from 20 to 45 and you're probably already underwater. We'll go through specific trading setups in the future episodes, but for now just remember to always keep an eye on Gamma as it may be your early warning signal. Generally, options that are at the money will have the highest Gamma, and the further the options are from that line, the lower their Gamma will be. Gamma is the reason why options feel different from stock. If you own the stock, a dollar move is a dollar move. With options, a dollar move in the underlying can have a much more significant effect. Remember when we discussed leverage with the options? They allow you to make much higher returns on invested capital, but on the other spectrum, they can also amplify your losses. Vega and Gamma don't operate in isolation. They work with delta and theta to shape your risk profile. Together, they tell you not only how much your option reacts to price and time, but also how much it reacts to changes in volatility and acceleration. Vega and delta. If you're long options with positive delta and positive Vega, you benefit from big moves and rising volatility. If you're short options with negative Vega, you get hurt when volatility spikes, even if the stock doesn't move against you. Gamma and theta. High Gamma options often come with higher theta decay. They move fast with price, but they also lose value fast with time. Low Gamma options behave more like stock and decay more slowly. Vega and Gamma, they tell you how much volatility is inside your option and how sensitive you are to price changes. They reveal how explosive or calm your position really is. Why Vega and Gamma matter to your trades? Vega is your volatility timing tool. When volatility is high, such as pre-earnings, big news, market stress, options are expensive. Vega is strong. It is often better to sell premium or stay neutral than to buy long options expecting a move. When volatility is low, options are cheap, Vega is weak. That's when long options, calls or puts, can be more attractive as you're paying less for volatility pickup. Practical rule of thumb, don't buy expensive options in high Vega environments unless you have a very strong, high conviction directional thesis. Remember, you're paying for volatility and price movement. And don't sell cheap options in low Vega environments unless you're comfortable with slow premium collection. Gamma is your risk amplifier. High Gamma positions change quickly with price. That is great if the stock moves in your favor, but very dangerous if it moves against you. If you are looking for less explosive and more predictable setups, go for low gamma as they behave more like stocks. Let's recap this episode. Vega measures how much your option price changes for a 1% move in implied volatility. Gamma measures how fast your delta changes when the stock moves. Together, they tell you how sensitive your trade is to volatility and how fast that sensitivity can change. And with that, we close this episode. If you found value in this mission, be sure to lock in your support by liking, subscribing, and following our movement. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, stay on target.